Much better.
Okay. All right, so let's jump in. I won't thank the people third time. That'd be too much. So these are challenging times and really full of uncertainty. So we go with what at ARS we look at the probabilities rather than the certainty of what we think is going on in the global economy. But there are some signs I think that are getting clearer that we're moving towards a period of slower growth, which is going to lead to declining spending both by consumers and corporations, which will lead to an easing of some of the inflationary pressures that are on us. So today I'd like to discuss the case for peak inflation and just jump right into it. We've had a problem with the war. Obviously, it's been a terrible humanitarian crisis, but it's an economic disaster as well. And it has led to significantly slower growth. But it didn't start with the war. It started last year as the emerging economies and other areas, after we had the peak growth, started to see growth slowing pretty aggressively. And it's led to, I think, an easing of some of the pressures that exist out there. But we'll get into this a little bit more. But that's one of the problems. You have slowing global growth. You also have global PMIs that have been declining, but they're still in expansionary territory. And I think that's an important thing to keep in mind because people are struggling with how come things aren't worse in some areas? Why aren't we seeing further declines in a lot of areas? And I think it's because the fundamental underlying economy was boosted considerably for the last several years, particularly last year by monetary and fiscal stimulus, which will remain in the system for 12 to 18 months. So we have these competing forces of slowing growth with an overstimulated economy, which is the overstimulation is what led to a lot of the inflationary pressures. And that was then further exacerbated by the war and having oil and food prices rise. So we do see we're still in expansion. It's slowing down a bit. We think the U.S. is in a little bit better position still, and because we've done a lot to stimulate, but as central banks continue to do what they're doing, you'll see some shifts going on. So there's several reasons why inflation may be peaking. Average hourly earnings, if you look at the headline number for the year over year, it's still up quite a bit. But if you look at the rolling 3 and 4 month periods, it's actually showing a significant slowing that makes it a lot easier for companies to handle the wage increases. I also think that you're seeing the same thing with core PCE, which their 4-month average is much lower than the headline numbers of the 12-month numbers. But we're also seeing a lot of anecdotal evidence of prices coming down. Obviously, lumber's been a big headline one, down 50%. Chip availability is coming back. If you saw Bloomberg today, there's a really interesting article on Bloomberg that they saw 3 things that were big changes in inflation. One is the semiconductor chip prices are down 14% since middle of 2021, but down 50% since July of 18. And that's really important because they're in everything we do. Everything we need is going to require chips. So that's a key element of the change. You're also seeing it in the spot price for shipping containers, which is down 26% since September of last year when it hit an all-time high. And now you're seeing North American fertilizer prices, which is an important indicator for a lot of the global food system. That's down 24% since its March high. So we are seeing some pretty dramatic moves that you're not getting from the headlines that you're hearing on TV or in the newspapers. It's really important that you go down another level and see what's really going on to the surface. And then today you had an interesting number from Target where they're getting clocked today because they have excess inventory. So while they were trying to build up for the stay-at-home stuff, we're starting to see the shift to return to work, and people are getting caught with bad inventories. So they're going to start slashing prices to get rid of the inventories. And that's something we haven't seen for some time. But if you go back to pre-pandemic, 40% declines at stores like Target and Walmart in price discounts were not unusual. So there's a sign we're starting to shift back to some level of, I wouldn't say normalcy because there's a war going on, but certainly an easing of some of the pressures that have been there for some time. I think these are important elements. And then obviously Chevy cut the price for their Bolt, Chevy Bolt last year. GM cut the price for Chevy Bolt last week, I think 20%. So EV is getting a price cut now too. So you're starting to see in a number of areas, things that are starting to improve. And I think that's getting lost in a lot of the headlines that you're seeing. Central banks are still tightening. You had the 200th one today with the Bank of Australia surprising at a 50 basis point move. Money supply growth has been changing. I'll show you some charts. But I think the other thing that's a key element that's going on here is hiring freezes and layoff announcements are starting to pick up very quickly. And you're starting to see CEOs and company executives starting to think that I'm going to have to prepare for more difficult times. That means they're going to be slower on hiring, slowing on refilling positions, and considering layoffs. And I think that's a significant shift in a pretty short period of time, that the mood has changed and you're starting to see that reversal. And all that leads to slower spending by consumers and corporations, which takes some of the heat off the inflation. So I have some charts we can go and look through. Here's our average hourly earnings. And the Fed's Beige book was actually interesting. They said a few districts are talking about leveling off of declines. What's really interesting is one district said they're just in decline on average hourly earnings. So what you're hearing and reading in the press and what you're hearing on the news isn't what's really going on in the numbers. Money supply took off last year. It went up quite a bit. It's starting to slow. The growth rate's starting to slow, and you see that turn. That actually also takes some of the pressure off inflation. And just this year alone, I mentioned we have 200 since last year of central bank rate hikes. We had 60 rate hikes from central banks this year, 61 now with Australia raising. And the ECB and the US are just starting to gear it up. And you add to that, the US is talking about reducing their balance sheet, and they're talking about 47.5 billion a month for 3 months, going to 95 billion for the next 12. That's about $1.3 trillion that's supposed to come out of the system. The central bank should be making that announcement so that they start to gear the market that they are going to be tightening conditions. But when they did this the last time they tried QE, they didn't quite get through. They did raise it, lower it, I think, by about $1 trillion. I think they can do more because we added more to the system. We're at a $9 trillion balance sheet, so we have to get that down. It's just how fast can they get it down, and does it take longer? And do we have to reverse course is one of the questions that we're going to have to see, because if growth slows too much, the central banks have to tolerate higher inflation because the economies are not strong enough to deal with the double problem of that, because they just don't have the cash to deal with it. So central banks will likely take higher inflation for longer just because they need to, because they don't have the firepower to step in again. If the Fed's balance sheet went from 4 trillion to 9 trillion, they can't really take it up ramp it up too much again. So they're going to have to manage where they are and accept somewhat higher inflation. Although I just gave a case that they're not going to have too much, so that might ease their process and take some of the pressures off. China's a big wild card, though, and I just want to touch on this because this is pretty interesting. I saw this number from Nancy Lazar and her team, but China's industrial production, if it slowed 1%, and I'm not saying it is because the way they manage their economy, you can't really predict anything about what they're going to do, but they have some real significant challenges there that they're working through. But if it slowed 1%, you could have a significant decline in certain commodity prices. Their projection for a 1% decline in industrial production, you could see oil prices globally drop 5% or more. So this is an important element to keep in mind. And I think China is going to be a tough spot until they get to the Party Congress, which is supposed to be in October, but they have sometimes moved it up. They may move it up because it'll allow them to get past where President Xi is reinstated for a third term, and which would be really reinstated for life. And then they can do some of the things that he doesn't have to worry about the PR for it and how that will look. So I think China's still the wild card in the inflation story, but there's also the other element, which is, are we going to end up in security blocks and economic blocks that trade together? And that will reorient supply chains and require maybe a little bit higher inflation or a lot higher inflation to reorient those supply chains. So it's really important to see how the global geopolitical situation plays out to have better certainty. But you can see what's happening with corporate profits and business confidence as we started to move into the third and fourth quarter of last year. And some of the companies were starting to feel the pressure of what was going on in the overall economy. Certainly not necessarily the big ones, but other ones. So that's actually a sign that corporations are going to have to sit and think, how do I protect my margins? How do I protect the share price? They're going to be pulling in some of the oars. And I think that will lead to some issues. We had higher prices, so they're going to have to try and offset that, which means that's part of the cause for the slowing of hiring and wages. So I think these are all interrelated, but a lot of it has to do with the confidence in the economy, and the confidence isn't there, and that will slow down CapEx for the companies that, particularly those that are highly indebted, who can't afford it with the higher interest rates. They're going to be in a tougher spot to deal with their debt servicing. So I think that leads to a bigger issue of the haves and have-nots, which I've talked about a lot over the last the whole time we've been doing this, I've always seen there's been three inequalities out there that people need to focus on. Country inequality, the ones that can continue to invest and grow and spend for their development, and those that are just in terrible financial shape. Same thing with corporations and same thing with individual households. So I think you have to look at those three dynamics and invest accordingly. I think there's some real challenges in a lot of the world, and even in the US, so we're gonna have to go through this, and slower CapEx may be one of the outcomes. But you are seeing the market recognizing that if you look out a little bit, the 10-year break even on inflation expectations is down. So I don't think it's going to be 10 years a long way out, so who knows? But if you look at the 5-year and 5-year inflation expectations, they're also coming down, and that's dropped pretty quickly. There's been a little spike up when the war started, but now I think you're going to start to see that easing. Oil is obviously the big wild card. There are projections that could go from 120 to 150, or it could just remain kind of steady at this level. But because of bad energy policy, I would ascribe that too. But I think we're going to have to deal with higher oil prices as part of the outcome of what we're dealing with for some time, because some of the shortages go against the shift to clean energy. That's going to make it more costly and more difficult to do. And you add to that the political dysfunction that exists in so many countries around the world of having sound longer-term policies, which is what you need to make major transformations, is just not there. We're too short-term oriented in so many of the areas that it's hard to get policy that lasts. And you're starting to see populations rise up against their governments right now, and you're going to work. Governments will then work more short-term oriented rather than more long-term oriented. So it really goes against this transition that we're trying to make. So OECD is forecasting again another view of inflation, pointing to lower price gains down as we go forward for all the developed nations. And I think that's an important element of what we're seeing, and looking past the near term and seeing where you want to invest for the longer term. So, how do you? On that last slide. Yes. When was that? This is in the last month. So, again, we're focused on quality, liquidity, and shorter duration on the fixed income side. We do like the US still, although there are opportunities. I think that's less about countries than it is about companies, whether you're in the private or public markets right now. I think strong balance sheets will matter more than they have in a long time. And you just think we have about $300 trillion of debt globally, and we've had a 2% move up in interest rates. So if that debt gets reset, that's $6 trillion increased interest costs to service the debt against a $100 trillion economy. So you just think about that number, and you can see where those highly indebted people are going to be in a real box. I do think the secular themes are the place you want to be, and we talked about that a lot over the last couple of days. The digitalization that has to go on and continue to go on to make companies more productive and more efficient. The electrification process of switching to green and cleaner and more durable energy is important. I think one of the challenges for a lot of people in this environment is dealing with the ESG mandate, while national security is such an important element and there's a war going on. It's one thing in peacetime, when we have a long time of peace, to say, we don't want to invest in the military and we can't support that. But if you're in the Ukraine right now, you'd be thinking we should have been, hoping they were spending. And the fight that they're putting up, we need to support them. And if the leading nations in NATO, it wasn't there stepping up and providing the support, who knows where they'd be right now. And they're still in trouble. We need to do more to help them. So that's a key element. But I think it's not just, weapons, it's cyber, it's food, and it's energy that you really need to focus on in national security. And as I said, I believe that's going to lead us to having trading blocks and economic blocks and security blocks with like-minded nations that could lead us to a democratic versus autocratic kind of divide, with another group of countries that are in the middle that are going to be playing both sides against the middle. China is, trying to get into the Middle East. They're trying to get into South America. We're trying to be players in both spaces. And if I'm one of those countries, I'm going to do what's in my best interest, which is play both against the middle and keep getting the best I can from both. So I think there's some really interesting dynamics going on. We believe that you still want to invest in commodity producers because they're essential to supporting the transition for the digitalization and electrification that has to go on. Healthcare is still a big issue. It's, we're in a pandemic that's coming to an end, but it's still not really close to an end in certain parts of the world where they haven't gotten the medical supplies that they need to deal with it. We also think quality dividends matter in this environment, but this is a period to avoid extremes in valuations. If you didn't learn the lesson from the last couple of months with the dramatic declines of 70, 80% drops in a whole range of things, whether it's not just crypto, but it's many of the tech stocks have had similar drops and declines. I think you can see a lot of areas where things have been knocked down quite a bit, but are still not investable, and some that have been knocked down a bit and are really investable. And I think this is a time to focus on earnings and those who can continue to spend to create differentiation and more efficiencies to improve their productivity. So this is a stock market that you want to own stocks, not own the market. I think you'll see money start to shift to really more focus in either the private or the public markets, where you're going to be very defined about where you're going after and who's going to benefit. So I'll stop there, Mark, and we can open it up for discussion.
So if you think inflation is starting to curve here, I mean, don't you then therefore want to take your foot off these defensive stocks, these commodity stocks, and then really go aggressively pro-cyclical?
A lot of the commodity stocks are needed for the transition, so they're not the commodities that they were before, the cyclical commodities in our view. They are actually going to be more stable, and you saw that with chips. Chips were used to be highly commoditized, where they would bounce around, where boom or bust regularly, and now chips have taken some of the cyclicality out of it because there's just not enough supply. We think in a lot of the commodities there's just not enough supply. An EV uses something like 10 times the amount of copper that a ICE does. Same thing with rare earths. It's 4 to 6 times the amount of rare earths are required for the electric vehicles that were in an ICE. So I think you have to think about not the whole commodities. You have to look at individual commodities and be very specific. And I think that's the theme throughout. You really want to target very narrow opportunities and see where where you're going to benefit the best, and have the slightly better odds in your favor, because there's still wild cards, obviously, in commodities as well. So you just have to be very defined. For us, it's a rare earth, copper, and iron ore or steel is where we're focused on the commodity side. And we are in the oil space. We've been owning the energy, the fossil fuel producers, as well as some of the green energy names too, both, because we think the transition requires both. I think it's one of the challenges for investing these days with mandates. If you're in an ESG mandate, you really need fossil fuels to get you to the transition. But if you don't invest in them, you're missing out on opportunities. So I think you should, for us, we think about it as a transition rather than one's bad and one's good. You have to get there to, with both to get there. And if you ding the oil the way they have and starve the oil producers from lending, then they're going to do what they're doing now, which is not produce and start milking the cow for cash. And I think that's one of the key elements. You're going to see more companies not spending and reducing their outstanding shares. And I think buybacks are going to continue to be a big part of corporate strategy to maintain their share price. I think that the other thing that's going to happen is people are going to be very focused on maintaining margins. So they're going to be really squeezing everywhere. And a lot of that's people and wages. So I think it all goes hand in hand.
Stephen, does this mean that inflation is transitory? That's the first question. Second question, how sustainable is this lower inflation trend, in your opinion?
Can I turn my device off?
Stable.
I'm sorry. Thanks, Adam, for reminding me that I used the term transitory a lot last year and had egg on my face for it.
You're not alone, Stephen.
Yeah, but for 113 weeks I have been. Listen, I think that was a bad definition. So let's just start with that. But I do think that without the invasion of the Ukraine by Russia, I think we would be in a very different spot for food and energy prices, for headline inflation. And I do think a lot of the other issues that we're talking about that are coming through now would have come through. So I think it's one that I wouldn't take the bait on. Is back to transitory or not, I would just say that some of the conditions that existed before would have led to lower inflation in our view if the war didn't start. Not that there weren't still supply chain issues and trade issues and all that, but I do think that would have been part of it. I also don't think some of the changes we're seeing will be reflected in the numbers right away either, because a lot of the prices are spot prices, not contract prices. And there's always a difference. The spot prices always run higher than the contract. So you won't see the lower numbers coming through until you reset some of the contracts. So I think that's one of the things, but directionally we are seeing easing. And, you know, when you see price cuts like Target's doing or price cuts like GM's doing on the Volt, that is a sign of an improving economy that can absorb greater demand without necessarily putting the pressure on it. And I think autos are a great area of, with chips supply improving and prices coming down, that will allow, and prices are only coming down because the supplies are increasing, and that's what's going to allow you to move forward better.
Last question. It sounds like the supply chains are stabilizing, and we're finding an equilibrium in those supply chains, at least for the moment, depending on what happens in Russia and in China. Would that be correct?
I would say they're easing. I'm not sure we're cured, because I'm not sure the geopolitical situation is clear enough that we know what's on the other side. And I do think there's a change coming that might require more trading blocks or something like that, that will reorient supply chains yet again and be a little bit inflationary as you're making the transition.
Thank you, Stephen.
You're welcome.
Can't see myself.
I'm sorry.
Not that that's important. I don't know. So my this point on doom and gloom, high inflation, slower growth. It's interesting that you had Neil Gupta from Kiwitech. They have 550 portfolio companies, and I'm curious what QCAers are seeing. They're seeing growth, and I know you've got a lot of data on the public side that you track. So, you know, I'm just curious if our audience or our community, you know, if what you're seeing in like the real economy, that you could shine lights on this. How are we seeing the economy?
Yeah,
Anybody?
more specifically, Mark, you know, hiring freezes, use of capital, any guidance there from people that are managing portfolios of companies would be really great to hear some feedback from the community.
I'll buy some time for a second. It could be that, you know, it's sort of like maybe like microclimate weather, that little pockets of areas are probably, you know, still going strong. I would say, you know, if you're a small company and you've got a great little niche, perhaps they're growing within their space. But it's one thing, you know, to talk about, you know, 10, 20, you know, $50 million, you know, revenue company versus, you know, hundreds of millions of dollars that have, you know, much more reach, you know, into the general economy and perhaps are more affected by the broader terms. That's just a thought. But also, Stephen, I wanted to ask, what do you know, because of sort of the lag on monetary policy, what do you think we might be seeing? Let's just create a scenario where, you know, we have like maybe another or two 50 basis point hikes, but then the data becomes clear and there is meaningful slowing. And so then the Fed and other central banks sort of take their foot off the brake. Maybe they don't put the accelerator on, but at least take their foot off the brake.
I think the last time
how do you see that?
The last time we did QT, it lasted a couple quarters, and then we reversed ourselves because things slowed too much. And I think the challenge is governments don't have the firepower that they did pre-pandemic to bail us out of a problem. So they know they don't have the firepower, and a lot of them don't even have the support from the public to do what they need to do. So I think that means that they would would ease quicker or not keep pressing the market up because they don't have the firepower to step back in. You know, we just blew $5 trillion in the last year, plus what we did on the monetary side. So the balance sheet expanded by, you know, globally something like, I don't know, 9 trillion or more. I forget. I think 9 trillion is just the US and the ECB. And then you added to it what was done on the fiscal side, and there's not a lot more, you know, money in the coffer. And people are going to really be focused on their deficits because as you move into a higher rate environment, refinancing is going to get tougher, more expensive. So that's a big issue too. So, you know, the US is what, 30 trillion in debt, you know, 2% on that's not an easy thing to swallow either. So they have to keep those numbers in mind. And, you know, I think this is part of where the, you know, we can debate QE in modern monetary theory back and forth, but, you know, in the practical, what they're looking at right now, they don't believe that they can just keep the printing presses running and get out of this the right way. So I do suspect, Bill, if you see easing of the inflationary pressures and a significant slowing of growth, that would require the central banks to step back and take their foot off the pedal. I do think what they're doing right now, and this is an interesting element of how the Fed plays the market with their communication, all the talking up they're doing is raising the expectations they're going to do more, which creates a sense of tightening conditions for businesses. Because if you think you're going to be in a much tighter environment, you're going to pull in the oars a bit. And that actually does some of the work for them by getting ahead of it. So I think that's part of the process that they're using, which then allows them to let the market do the work for them and then not have to do quite as much. And it will be less expensive for them if they do it that way.
Yeah,
That's helpful.
but I think that's a great point. And also it'll be really interesting to see if in fact that plays out. Can we survive like without the punch bowl? And based on the you know, sort of the tendency for investors and businesses to have such short memories, that maybe the memory of the inflation will be more prominent, so that when things ease up a bit, maybe you don't need the punch bowl anymore and can just move forward. I don't know. I mean, that would be a great scenario if it plays out. I'm just not sure.
I don't know that it just isn't wavy though, Bill. You know what I mean? The
Yeah.
short-term economic cycles that everyone reacts to. So that's one of the issues that we're going to have to see. Is it you know, the giddy up whoa approach to managing a country. The other one, I don't know if you can take the punch bowl away from the politicians right now.
Right.
You know, they're back at it again today. They're seeing if they can find another way to do more, do the Build Back Better program again at a smaller amount. So I think there's, you know, I don't know that they can get off it, which is another interesting. The implication of that is that you'll have more money going to the system and you may have higher inflation if they don't get it right. I just don't, I don't think they think about it, the economics as much as they think about the election. And the midterms, look, this is an interesting one because I've seen some numbers that not only could the Democrats lose the House now, but they could lose it by so much they might not be able to get it back in the next presidential election. That's how much is at stake in this one, which I think may push them to do.
Everybody remembers last week, inflation at an all-time high, Gallup,
Yep.
and Biden and Yellen was on today is getting the blame.
What was the print last week?
Well, 8 something, 8.3, something like that.
The one before, right?
So, yeah, Stephen, you used the Chevy Bolt as an example of inflation. I'm not sure I agree with that. It's 6-year-old technology. It's total refund because of energy costs. I'm thinking it's more specific problems.
I see Steven talking, but his audio is on mute.
Mark, I think you muted everyone.
Okay.
There you go.
So did you hear the question? The question was, is the Chevy Bolt price reduction a reflection of problems with GM or a sign of easing of inflationary pressures? And I think it's probably a little bit of both. But I think for the EV area, the biggest part was getting the chips and other materials needed. And I think that is easing. You do see port congestion easing in the ports of LA. I would say, while we're talking about inflation, the big worry is there may be a strike in the ports over the summer, which the government would probably have to step in and not allow that to happen because they couldn't afford that in an election year anyway.
40% of the inventory.
Yeah. Yeah, so, if that happened, that would be a problem. So I think they're going to do pretty well on their negotiations for their wage increases. But I do think it's a combination of problems internally with GM and Ford, but also problems with and being competitive in their cars and problems easing of the supply chains easing. So I think it's a combination of both.
What's your sentiment towards the likelihood of a recession?
Well, we're definitely going to have one. I don't know when, but I don't think it's necessarily near term. I think you can't avoid recessions and economic cycles, but I think the odds have moved up. The numbers I'm seeing from the leading strategists I follow, which would be Nancy Lazar, Ed Yardeni, and Ed Hyman, are all in the kind of moved up to the 35 to 40% level. I think they probably don't feel that the odds are that high, but it might have felt a little out of step if they didn't start moving it up a little bit more, because they're very much in the peak inflation camp right now.
Do they say when they expect to see it? Percentage of the when?
Yeah, they don't really, it's really late, it's probably into 23 for most of them is what they're looking at now.
Stephen, do they give any sense of the amplitude of the recession?
That's where a lot of the big debate is. I think a lot of people think it will be shallower than past, but nobody really knows because the two big issues that are driving it are the war and the pandemic. And China's a big wild card for that because if China opens up again and you start to see stuff flowing more, they could ease some of the pressures too, or they could create new ones, depends on how their demand goes. So it's really the war and that are a wild card. And it looks like we're going to be hunkering down for a longer slog with the Ukraine. So I think that's the other wild card there.
Both in Cincinnati and Columbus, we talked about disruptors. In any market, some companies will do well, but also some parts of the country. And yesterday's discussion about Intel.
Yep.
It's like the issues are getting people to do construction. Like this is growing just so fast.
And now you get me into one of my topics that really drives me nuts about our country, is our immigration policy is completely wrong. It's wrong on so many levels, and the debate is also wrong. We allow basically 85,000, maybe 100,000 skilled labor, skilled students, graduate and undergrad in, 60,000 undergrad, 25,000 graduate students. I think we're going to get something like 400,000 applications for people who want to come to this country and be an active part of a system that needs help. And I don't have the number on that, but a lot of them are actually, when Trump was in office, there was a net migration back to Mexico. So we were building a wall to keep them in, apparently, not let them out. So I think the dialogue on that's the wrong one, because illegals are going to get in if you don't fix the things that will keep them out. But we can bring in productive workers to fill a demographic gap that we have that's growing. Our replacement rate is not very good. For birth rates so low, fertility rates so low in the US, and we're going to have a labor force issue that you might not be able to solve with all robotics. So I think that's going to continue to be a problem. And I think you're going to see, even in boom areas, if you're not doing the things to attract talent there, you're going to have a problem. And the US could solve the problem a lot. Canada, for example, I think they bring on average about pre-pandemic 300,000 to 400,000 skilled workers into their country a year. Their population's 1/10 the size. And at one point, they're running billboards in Seattle. H-1B visas come here, they'll give them to you. So we're draining talent out of the US too. It's moronic policy that they can't get them out of their own way.
And the education sector, I mean, teachers are leaving in droves and administrators are leaving in droves. And so with everybody, I mean, they can't get hires right now. So it's going to be interesting.
The
to see.
healthcare,
Right, so when Intel comes and the schools get impacted, who's going to teach them? So it's the secondary services that are going to need to really figure out how they're going to get people there.
glad I'm not the lieutenant governor or the governor here right now.
What's the solution?
Exactly.
I don't know what their proposed solution is to deal with the Ohio problem. I think the solution to deal with the other problem is to get our politicians to think differently about bring in people who want to come here and be productive members of our society.
Or, wow, maybe pay teachers what they're worth.
Well, the teacher one is a different issue. Pays a different issue than supply. I think the supply issue is, talent, but you're right. Hey, wages are
But
key.
it is supply issue though.
Yeah.
How much is Russia burning aid from that war? How much are they spending? It's like their resources are not.
No, and actually there's a problem though. They're going to have a chip problem because they don't make many chips there, and they're starting to feel the pain. So some of their military stuff, if they need to, and they're going to need to resupply they're not going to necessarily have the chips they need to do to run their economy. So there are elements that they're getting hurt by the sanctions in ways that are less obvious, that are going to start to show as they burn through their inventory of what they have inside their country.
I have heard that they are switching to using Chinese chips.
Mhm.
Don't know, they tend to be less sophisticated than alternatives, but
What kind of chips are you talking about?
This full range of semiconductor chips, the whole range, they need them all. Yeah.
ASICs,
Yeah.
CPUs.
They need, and they're actually having problems with the less expensive chips as well
Yeah.
right now. So
There,
we have Adam?
yeah, there is a big shortage of electronics in Moscow and in Novosibirsk. And the guys that work with the electronics now don't know what to do. And it's a feeling that they're going to go back to the 1970s, having to scrounge and put things together.
And to give you a sense, because China has a good sense of how Russia's hurt by this, one of the senior people in China announced today that they have to look more aggressively at Taiwan Semi, so that Taiwan Semi doesn't take all their goods to the US and then make China completely hold them to another place for the highest quality chips. Yeah, so this is where the sanctions are really, they're interesting because they've really created a pressure on China to rethink how would they deal in a world if the NATO nations all put the same sanctions on. They're preparing for that now. So China's looking at the long game and figuring out how they're going to play this, and it does create some pressures that they're going to have to figure out.
And just to put that in perspective, anecdote that China spent as much on chips as they did on oil last year. So it to your point, Stephen, it is not an insignificant issue.
Yeah.
To your slide on the.
What did we spend? What did we spend on chips versus oil for comparison? Any idea?
No, I don't.
Yeah. I know you'd ask that, Duncan. I don't know either.
Apologies.
Where you talked about the percentage point pullback in Chinese.
Industrial production.
Industrial production. Is that determined, there are two parts of that. Is that global demand? Or is that a idiosyncratic situation with China where we're seeing the impact of tariffs, we're seeing the impact of US manufacturers looking to relocate to, say, Vietnam or wherever else?
That was a hypothetical. If China industrial production dropped, that's what it would be. That's the impact it would be. It shows you what a swing China is in the whole system. But I do think that China's starting to see their numbers slow, and they may produce lower GDP growth than the US does this year,
Yeah.
which would be a really not a great thing for somebody in that party, not Xi, but somebody else. No question in the back.
Actually, I'm surprised you didn't mention about the government dropping tariffs on solar panels.
Oh, we did. Oh, did that reverse?
No, there's an issue with solar panels and dumping from China that certainly goes against the green energy transition. We own a company that in our portfolio that was a big beneficiary of that yesterday, that changed. It's a big announcement because, you know, the dumping issues are always an issue here, but you got to be careful if you're creating obstacles to transitions that you need to make. That is a key element of it. And I think that this is where our policies really need to be a little bit more thoughtful.
Well, they just want cheap solar panels, right?
Yep.
So that's why they didn't go after.
Yeah.
Do we have any visibility into like, you know, how China's blocking out a lot of cities to control them? Any like concerns about domestic violence or anything there?
You know, there's a lot of talk, is she vulnerable because of some of the comments out of Premier Lee and whether he was, you know, trying to angle for something with, and the way President Xi's managed to position himself, I think he's rock solid for where he's going to be for a long time. He's eliminated through corruption investigation and other things some of the threats to his long-term tenure. So I don't think he's vulnerable at all right now, and I think that's one of the issues. And I do believe they may move up their party Congress. And if they did, it would allow them to be less concerned about what the public opinion is and really go after some of the things that may be important for them to do for their economy would slow down growth and impact people negatively. So I think there's a really interesting dynamic with China, which makes it such a wild card, because when the second largest economy, you don't really have clarity on where they're going. It really puts some uncertainty into your outlooks.
Stephen, there hasn't been much news about the Chinese real estate sector, where it was on shaky ground not long ago. Have you heard anything more about that?
Yeah, the ground hasn't gotten any firmer.
Yeah.
It is getting worse, but they're actually pressuring the local governments to do more. And actually, this is what they're doing is, you know, they're pushing the responsibility down to the local governments and saying, you have to fix your problems. And then they'll replace them if they don't fix them, and they'll just say, we're working to fix them. But I do think there's a lot of fragility in the Chinese economy right now.
Are they telling the local governments?
Yeah.
The whole problem with the housing market.
When they just built so much.
Yeah.
They built all these cities that were ghost towns and are still ghost towns.
Right.
They built ghost towns.
There's nowhere to deploy cash into the stock market.
Yep.
Question about the currency. The US dollar's strength has kind of tapered off a little bit here recently. But the strengthening dollar has a positive impact in terms of easing inflation, global inflation.
I think we might see the peak dollar now too, because as the ECB starts to raise rates, then, you know, the euro will become a little bit more attractive because they're doing better, you know, doing right and tightening their conditions too. So hard to say that the dollar should remain the reserve currency. I think one of the things that people get wrong is it would be very hard for an autocratic government to be the reserve currency of the world. Right. Just, yeah. Very hard to see any autocratic government do that. If the US went autocratic, I don't know that we would be able to. Yeah, nobody would have any trust in it. So they would seek other currencies. So and the US has had, you know, the rule of law and other things behind them that, you know, add to that, which is why we really have to be careful about our deficits and not continuing to pour it on too much.
will become the global currency, right?
I don't know. I don't know how that one's gonna work out. I'll leave that to smarter people.
My first thought is that they would trade within the blocks that we've been talking about. But then you have those swing countries, they wouldn't trust their.
Yeah, I actually think that one of the more likely outcomes is we end up coming to some kind of détente with China and kind of figure out a mutually agreeable arrangement that they can get away with some stuff, we can get away with some stuff, and we'll.
So that
Yeah.
was like a scenario 5 or something at
Yep.
2040.
Yep.
You see it going into the worst scenario.
Yeah.
You pop out of that into the best scenario.
Yeah, I don't know. I think that eventually leaders want to stay in power, and to stay in power, you need to have a population that's comfortable with what you're doing, and you only can do that if the economy is moving at a pace that's sustainable enough for people to be able to live.
Do you have any visibility to the war? Or what thoughts on like how long this plays out or what's the objective?
You gotta know what's in Putin's mind to know how that one ends, and I'm not sure who he even knows right now. That's the wild card, and that's always going to be a level of uncertainty that we can't deal with. They keep ratcheting up the threats of, what was it this week? We'll hit unexpected targets now. Is kind of, he's throwing the nuclear threat around quite a bit without saying it. So I think there's no real insight into how that ends, other than it looks like it's going to drag on for a while.
Are they advancing? They're kind of like just stance on these, just that, they pull back.
Slowly advancing.
Yeah, they're making progress, but it's at a big cost.
Sure.
So
It's a stalemate,
Yeah.
and it's, the Ukrainians are making good progress when you consider, that they're outnumbered significantly.
yeah, they've
But
battled well, but the area that they're fighting in the region that Russia's most active in plays better to the Russian military tactics than trying to get into the major cities. So, it plays more to their traditional military and missile capabilities than it would trying to take over the major cities. I think that's the issue. And I do think the further they get away from their supply chains, the weakness of the Russian supply chains is starting to show as well, which is part of the problem. And I guess the other issue, and, Simon or some of the other folks with affiliations from back home might have a different view, whether they're starting to lose the morale of the troops seems to be one of the things that the longer this drags on, the less eager to fight some of the people are. So I don't have any insight to that. But that's one of the things we've been hearing a bit more of. So I don't know, Simon, if you have a view on that. Or Adam.
Well, Putin is having problems recruiting, refreshing the troop numbers. And they just lifted the age restriction on those who can volunteer, which tells you a lot. And the conscripts that are recruited are not trained. I mean, they're really going there as cannon fodder.
Mm-hmm.
So it doesn't look good. And when Putin talks about the nuclear card, keep in mind that the Russian military does have in their doctrine the use of first strike tactical nuclear weapons. That is in their doctrine, unlike the United States.
Simon?
I cannot comment on the situation in the army. I just read the same newspapers as everyone. But some of my friends who dare to go back to Moscow to complete some of their business affairs, basically commented that number one, anyone who has a foreign passport is invited for a conversation, and who comes back to Russia is invited for a conversation to discuss what they were doing outside, which is kind of unheard of. And the second thing is that even if people are very old, So my friend's mother is almost 80 years old. She is a Russian speaker with a foreign passport. She was invited for an interview. And the second thing, another person told me, and actually a few of them at different times, that it is amazing how many even well-educated people are completely zombified and talking as if, you know, they're repeating the state propaganda. So I guess the ideological part of the Putin's campaign is succeeding in Russia. I know many people who want to leave Russia and don't know where to go, and they're scared by the actions of the Western governments, which basically make any holder of a Russian passport persona non grata. Many of them would leave, but still there are plenty of those who bought the propaganda.
And the tragedy that's going on in Ukraine now has, I think, 6 million people have left, and there's another 7 million that have been displaced. And we're gonna have a massive rebuild that's gonna have to go on at some point there. And that's gonna be a big bill too. So, you know, aside from the humanitarian tragedy that continues to go on with that, you're gonna have an economic problem, crisis as well.
Those
And
cities are doomed.
yeah,
Completely.
Yep. Yep. So that's going to be an issue. I have to say I was pulling for the Ukrainian soccer team against the Welsh, against Wales. I had, no, they lost 1-0, and it was a tough loss at that. I think it was an own goal, but it was heartbreaking to see that they lost that game. But the game before, the coach was so emotional that you couldn't help be moved by seeing his reaction to the win that they had before and what it meant for the country. And they were told what it meant for their soldiers for them to do that. And the coach tried to enlist, and they told him they needed him to take the team forward and
I think the Welsh
compete.
coach should have told his team to back off a little bit, right?
That had made the Olympics for 46 years. So I think that or something like that. So I don't think they were going to back off, but it was heartbreaking to see.
These are for the Olympic plans?
I think so, for the Olympic plans. Yep. So.
Any other questions, comments before we wrap up?
Thanks,
Thank
Mark.
you, Stephen.
Sorry,
Thank you again.
I alluded to it before. Where do you see, you know, obviously we've got these prints of 8.3 or 8.5 year over year. Where in the Fed's policy is of course right around, I think where they was it 2.5% is kind of where they want steady state inflation. What are your thoughts on steady state inflation kind of post? Mark, you said if it comes down to 4%, is that what kind of world does that create in terms of?
And we've lived with
rates?
For almost all our lives, we've lived with more than 4% inflation in the US. Right. For almost everyone on the call, they've lived with more than that. Right? So you can live with 4% if you're not heavily indebted, but we're a highly indebted nation. Fortunately, a lot of the households have improved their positions since the pandemic started. They've actually improved their balance sheets, but this is where the have and have nots really comes in, and who can afford that. And if you have young kids trying to start their careers and trying to get apartments and move into a city or something, it's unaffordable for most of them. So where the jobs are, they can't afford to live, and what's the commute? And then the commute, they're not making enough money to cover their costs for their commute. So there's real issues that we're going to have to deal with. It's very similar to what we, when we had the higher inflation in the 80s, in the early 80s, it's really, it takes some time. So I think that this is going to be a tough time for a couple of years. It's no easy outcome from this. It could be longer, but you had to start with the premise that there's no quick fixes coming here. But I think we could live with inflation if we can get enough growth going. We need growth, and we're starting to see it. We just have to maintain it. So tough answer to a tough question. So
any last comments, questions? Well, my wrap up comment is, again, thank you to everybody who helped us in Cincinnati, Grand Hope, Columbus, will make it a complete one. Finish the highway tour.
Jack might boycott though.
We're building bridges. Now you said Jack. We're gonna pop on there. But yeah, and thank
Poke
you.
the bear.
Thanks, everybody. We're next going, we're gonna be in Newport, in Boston. And we're trying to figure out, we're gonna be in the West Coast. And release when, second session, we're gonna be there, just don't know when. In London, we're gonna skip Monaco, or postpone that and go to Germany and Switzerland. That's the week of September 19th. We will do the Hamptons for a day or so on the August 4th. But we can do Zoom stuff all the time, right? And we will. So thank you, everybody. Ohio is booming. Come visit and take care of it.
Thanks. Have a great day.
Thank you.